Hello, my name is Jacqueline Barco and I am a Clinical Assistant Professor of Accounting here at Indiana University Northwest. In this video, I am going to discuss with you record keeping and cost terms. First, I will discuss record keeping and how it fits in with other financial items included in your business plan. Second, I will discuss various cost analysis items. You want to be sure you start off with a plan in place for keeping records and how you will maintain such records. Record keeping includes both maintaining physical copies of items like receipts, but also have a system of organizing and using them. Keeping accurate records helps document and improve your profitability and cash flows. Your record keeping methods should help you visually recognize open accounts, cash flows, profitability, and what you can consider doing to improve. Keeping track of your income and expense sources will be beneficial for tax purposes and help get your business started on the right track. Your business plan should indicate your plan for record keeping, organization, and how you can keep the business profitable. You should consider maintaining separate bank accounts for your business and personal needs. Using your business plan for financing, your business bank will be the primary focus. If all business income and expenses are run through the bank account, this will be more transparent if kept separate from your personal expenses. You may consider a software of some kind, like QuickBooks, to help get your business set up and maintain organization. Any accounting information system software will help, but be sure to pick one that meets your business needs. You may also indicate how your chosen method will help as you adjust for needs. For example, if you see from your payables report that you have many payments coming due, you may have to make changes to your cash flows or cash reserves. There are a number of cost terms that you should consider for your business plan, and every company is going to be different and therefore come with different needs. In this presentation, I'm going to address startup costs, cost of goods sold, and the differences between fixed and variable costs. In the financial statement video, we address more analysis items you may consider including in your business plan. Your business plan should include a detailed list of the expenses you anticipate. You should distinguish between startup costs and recurring business costs within your plan. Describe the costs you deem necessary to get your business up and running. These will include organizational costs and cash reserves. You should also identify critical costs and be able to identify costs that may be adjusted if necessary. Identifying these startup costs are going to help a user of your business plan identify what needs you have and how you will use them to grow the business. You should be careful to identify the estimated costs, whether it is one-time or reoccurring, and how accurate the estimate is. For example, if you received an insurance quote, this cost is more likely to be accurate than if you estimated the cost based on an internet search. All costs in the business plan are going to be estimates, but showing how you arrived at each will not only demonstrate that you have done your research, but give a baseline for your needs. You may consider organizing your costs something like this. Here you see the type of organizational cost, the estimate, and whether or not it is one-time or reoccurring. If it is reoccurring, what is the reoccurrence? Please note that each organization is going to have different startup needs, and it is difficult to provide a precise list of those startup needs. But here you see they are organized by costs necessary to open your business, such as any required licensing or insurance. Then bases on what is needed to be ready to open the door that will be reoccurring. This might be inventory, employees, or rent. Next, you will have your one-time costs associated with opening, such as employee training, equipment purchases, or others. Finally, you should have cash reserves of some kind built in. Despite your best estimate efforts, you should anticipate some unexpected costs and have the cash reserves available to avoid disruptions. Cash reserves should include a 10% contingency for emergencies plus extra for startup costs. The recommendation may be 50%, which is not always achievable, but poses the least risk. When you identify your risks, see the risks, assumptions, and financing video, you may include your cash reserves as a risk mitigation. Once you have your startup costs organized in this way, you should include your expected payback. That is, based on your expected cash flows, see the financial statements and cash flows video. How long will it take to recover your startup investment? You may also present the net present value of the business by identifying the required rate of return, the initial investment, and the cash flows in each year. If the net present value is positive, you are anticipating a profitable investment. Cost of goods sold includes your product costs. If you're selling retail items, this will be the cost necessary to obtain your inventory. If you are making your own or selling other products, then you will need to include other costs. For example, if you sell baked goods, you will need to include the materials needed, the labor time, and all overhead associated with making the baked goods. You'll also need to add in additional packaging, napkins, etc. Your business plan should include a breakdown of your expected cost of goods sold to as much detail as you are able. Maintaining accurate inventory records is important to your business. If you are not keeping track of your product costs, you run the risk of underpricing and losing money, or overpricing and losing sales because a customer can find better deals. If you are offering a service, your costs will be broken down by labor or supplies needed. As with all costs, the cost of goods sold and cost of sales will vary by industry. Be sure you spend the time analyzing your specific product or service costs and include this in your plan. Your business plan should distinguish between fixed and variable costs as well. This will help you justify your break-even point, and based on your expected sales and expected revenues, your projected net income. Remember that fixed costs will not change as sales adjust, but variable costs will increase with each additional sale. Your contribution margin on the next slide should show just the variable amounts. Your break-even point is the point where your profits are zero. If your anticipated sales exceed the break-even point, you demonstrate hopes of making a profit. Remember that all sales and costs, both fixed and variable, are estimates, so you want to be sure to document in your business plan the assumptions you made with each estimated amount. Your contribution margin is sales minus variable costs. You can look at this at a per unit level by considering your sales price per unit minus your variable cost per unit, or as a whole by looking at all sales minus all variable costs. Remember, fixed costs should not change, but variable costs will increase with each additional sale. Therefore, our break-even is going to be the point where your contribution margin minus fixed costs equals zero. A sample contribution margin statement here may be included and compared against your fixed costs. Remember that this is for your sales and to demonstrate your ability at a minimum to break even. If your projected financial statements, see the financial statements and cash flows video, show sales above the expected break-even point, you are on track to make a profit. Remember, these are all projections and estimates, so you want to be sure that you have enough research put into this to being accurate. Remember, your objective is to prepare a business plan with a sound understanding of what your business will need. You should include in your plans for maintaining records and how you will use these records to assess profits and maintain positive cash flows. Your startup costs should include as many necessary costs as you can think of and explain whether it is one-time or reoccurring and what the estimated cost is. Your cost of goods sold will help with accurate pricing, and distinguishing between fixed and variable costs will help demonstrate your projected capability of generating profits. Thank you.